The stock market reacted negatively to the Fed reducing interest rates by 25 basis points and not confirming that they would do it again. Having extremely low interest rates is not enough. They want to know that an even easier policy is coming soon. But what was largely ignored was the balance sheet. Not only is the Fed going to stop the QT policy, they're stopping it much sooner than they were going for. This is perhaps the more important factor. You came here for the truth, so let me unveil that for you. I'm sure you're aware the Federal Reserve cut interest rates by 25 basis points or 0.25%. They did so, number one, as an insurance cut, this is their terminology, as well as the fact that there were some outside issues going on globally that could spill into the United States, so they decided to cut rates by this marginal amount. Now this here, of course, created a problem within the markets. They didn't like it. They reacted negatively to it. I covered all the details of that in the previous video. If you haven't watched it already, then I will link to it at the very end of this video. This here is talking specifically about the balance sheet. If you look at what had happened today in the mainstream media, they were always exclusively focusing on what happened with interest rates. Yes, that's important. Yes, that needs to be documented. But what wasn't really brought up in the spotlight was the fact that they are going to end their QT policy much earlier than expected. I'm going to get into all the details. I'm going to break it all down. I think this is so important. I'm going to show you what was said by Janet Yellen back in 2017. I have the documentation to show you. I'm going to look at what has going on with the central bank balance sheets, with the Federal Reserve, but also others around the world. I have a lot to cover. This is jam-packed. We're going to get into it right away. I think it's pretty obvious what happened. You've seen it yourself, but I'll just quickly go through this and a couple other things. The market did not like what happened in the Fed statement and the speech afterwards. You can see what happened. Markets going into the red, and now that is spilling over into the Asian markets as well. As you can see that they are down significantly. This looks like they didn't necessarily want the interest rates to be cut 25 basis points. They wanted them cut by at least 25 basis points, and to know that there was another cut coming right around the corner. Well, Jerome Powell didn't necessarily want to say that, and now they're going to have to create something, whether it's a conference, whether it's a statement, or some sort of policy initiative that's going to fix it. Okay, they have to make it seem like, don't worry, we're going to react accordingly. All right, we're going to sustain the expansion. He said that maybe 15 times at least throughout this statement that he made, but the market didn't think that was enough. All right, so I have a lot to cover here. I just wanted to get into what happened previously, because if you haven't seen that other video, just going to mention a couple points from it. The two words from Jerome Powell that rocked the financial markets, specifically mid-cycle adjustment. Okay, so I mentioned this again. If you have seen that other video, don't worry, because the reason I say this is because what we're looking at right now is, in my opinion, the admission that this is a weakening, that this is a slowdown, and they're not saying that. They're not willing to say that. They are basically going out there to the public suggesting everything is fine in the United States. We are totally fine, but what's going on out there could become a problem for us. So we're going to cut interest rates by 25 basis points to fix it. Now, to me, that doesn't make any sense, because a 25 basis point cut really won't have any impact. This is what you do at the start of a cycle. Now, maybe things can pick up. Maybe things can get better. Maybe manufacturing will get better. But as of right now, that's not the case. Cutting interest rates by this much simply will not fix it. So I believe that what we're being told and the actions that they're taking are two very different things. Whenever the Fed makes their statements and their speeches, you always need to get it directly from the source. Yes, we can look at the CNBC articles and so on, get the little snippets, get the talking points, but ultimately you're not going to know what's really happening unless you read them yourself from the source. This is from the federalreserve.gov, and of course, at the beginning here, we're talking about the interest rates, we're talking about the economy, what they did. At the very bottom of this, however, they had some information that I wanted to share with you, and that is really the central theme of today's video. The committee will conclude the reduction of its aggregate securities holdings in the system open market account in August, 2 months earlier than previously indicated. They make sure to mention that was 2 months earlier than previously indicated here. They're trying to suggest that the market, look, we're actually bringing the schedule up, we're going to end it early, and everything should be fine because this really has an impact on as if it was interest rate reductions. Okay, this is something very important. If you've been watching the channel for a while, you know about the shadow Fed funds rate. So basically what happened throughout this period of money printing, quantitative easing, when they printed that $4.5 trillion, it acted as if the interest rates were brought down to a level that was minus 3%. Okay, hard to explain, but look up shadow Fed funds rate if you want to check into it yourself. This is very important because when you see the effect of it, obviously this keeps things moving. The liquidity needs to be there in the system for it to become operational, and that's really having a hard time right now. If you think about it, all of the activity really slowing down despite the fact that interest rates are still extremely low. So they're trying to bring that down, and of course part of that is their balance sheet. If you look way back, you would see that they were talking about reducing their balance sheet at a very slow pace, this and that. We're going to look more into that today, and I want to give you an idea of what happened 2 years ago and how very different that is from today. I also wanted to note at the bottom of this, they tell you who voted for and who voted against, and you could see that there were 2 individuals that voted against and the remainder voted for. None of them voted for a 50 basis point decrease. Everybody that voted for it was going 25 basis points. So I just wanted to give you a breakdown of that because it wasn't really seen as very important by the mainstream. They were simply looking at how much the interest rates were dropped by. This right here is the Federal Reserve's balance sheet, and you can see, according to this, $3.8 trillion worth. They tried to reduce their balance sheet over this period of time, the QT policy, quantitative tightening. After having nearly $4.5 trillion on their balance sheet, they wanted to bring it down and quote-unquote normalize it. This is a process that they said would take a very long time to do. They would slowly but surely just let the balance sheet run off. It would be a natural process, and people would have a predictable way to understand where they were going. The market actually, if you look at around the time where they started introducing QT, it seemed like they were very favorable to what was happening. It would be nice and slow and steady, and they were all for it. Of course, then 2018 happened and things really changed. They started to hate the QT policy, they started to hate the interest rate hikes, and of course here we are today. They suggested that they're going to stop this earlier than what they planned on doing, and that was way earlier from what we thought was going to happen at the time that they started this. So we're looking at an actual admission that things did not go the way they planned. I want to make that very clear here right now. You're not going to get it in the mainstream, you're not going to get that from the Fed. This is very clear to me. I'm simply piecing it all together, and I know you're seeing it too. Let's look at what Janet Yellen said back in 2017 about this entire QT process. I'm going to read through this. I'm going to do it as quick as I possibly can. It's very important in the context of this video. So we have indicated for quite some time, I guess, at least since our 2014 normalization principles, that we wanted to reduce our balance sheet in a gradual and predictable way. And we have tried systematically to communicate more about how we would do that as our plans have evolved. And today's announcement is another step in providing further details about how we plan to proceed so that when this plan does go into effect, no one is taken by surprise and our market participants understand how this will work. Exactly what I said previously, that it's going to be predictable, they're going to know what's going on, it's going to be slow, it's going to be gradual. That's the plan. I think the plan is one that is consciously intended to avoid creating market strains and to allow the market to adjust in a very gradual and predictable plan. My hope and expectation is that when we decide to go forward with this plan, that there will be very little reaction to it, that it's clear how we intend to proceed, and that this is something that would just run quietly in the background over a number of years. Remember that. leading to a reduction in the size of our balance sheet and in the outstanding stock of reserves. And that is something that the committee will not be reconsidering from time to time. They were going to do this. It was going to take years, but it would be slow. The market would like it. The Federal Reserve would be comfortable with it, and everybody would be happy. This is where it gets funny, and you probably have heard this quote before. We think this is a workable plan, and it will, as one of my colleagues, President Harker, described it, it will be like watching paint dry. That this will just be something that runs quietly in the background. So that's my expectation and our intention. This is where it starts to turn. Look, of course, if it turns out that there is a surprise and a substantial reaction, that is something we would take into account in deciding on the appropriate stance of policy. Basically saying, if there's this big shock, we're going to stop the QT. Now, you tell me, after all of this, what exactly was that big shock? What has happened to make them stop the QT policy? At least we look at all of the stats that they show us, the unemployment, we're looking at the inflation, we're looking at the data that they present us. Nothing's a real shock, nothing's a real surprise. Things have been happening slow and steady. Yeah, manufacturing is down when they look at that, but they don't put too much weight onto it. Business activity is a little slow, certainly, but the consumer is so fantastic. Everybody's working. Things are good. According to the Federal Reserve, things are good. So then, what has changed since Janet Yellen, we're looking at the data, 2017 compared to now? Something big is going on. They are not admitting it, but if you piece things together, you start to understand it for yourself. This here is from Yellen research, and I think it's important to look at the balance sheets and get all the data that you can. Yellen puts together this on a regular basis. I found the most recent data. It happens to be from July 31st. I'm very happy it's timely with this video here. And of course, if you want to check it out, links will be in the description. There were a lot of charts in here, but I just want to cover a handful of them because they relate to this video specifically. Let's get into it. The total assets of major central banks, specifically yearly percentage change. Look at what happened from 2017, 2018 especially. They started to reduce the amount of assets that they had, or at least were purchasing less. That slowed the market down considerably. Yes, they have changed that. You can see that it is not now starting to make its way into positive territory. And of course, the market will react positively to that. We have seen this happen throughout 2019. Total assets of major central banks. This is the yearly change in trillion dollars. You can see that similar activity on this chart. Total assets of major central banks, you're looking at the Fed, that's the red line, the ECB is the blue line, and the BOJ is the green line, trillions of dollars. They have exceeded where any of them said that they would be. No central bank out there said we are going to print $5.5 trillion worth over the next few years in order to stabilize this system. They all said we're going to do their own version of QE1, and that's it. We're just going to do that, have it go, and it's going to fix everything. When things are back to normal, we are going to be able to increase interest rates, reduce our balance sheets. It's all good. That didn't happen like that. Not at all. Not even close. Here we are today. If you look at the Federal Reserve, they have the least of the three, but certainly it's not small by any means. Total assets of major banks, we are comparing the ECB, the PBOC, you're looking at the BOJ, and all of these put together just shows you what they did over the years since the financial crisis. All of them have printed a lot of money. Here's the total showing us just from the Fed, the ECB, and the BOJ. You can see that they have printed $14 trillion since this moment. We can see that this is excessive. It has gone beyond, far beyond where any of them said it would go. And this is just the three central banks. $20 trillion, excess of $20 trillion was printed just since the financial crisis in order to save this market from the absolute destruction that it would ultimately cause. Imagine this. They had to print this much money plus the $16 trillion that the Federal Reserve never admitted. You have an unprecedented level of support and stimulus being given to the markets that we're being told are so strong. We got something very wrong right now. Okay, just a couple more here. Total assets of major central banks as a percentage of the local currency nominal GDP. The BOJ is just going to excessive levels. They are printing so much money, buying everything that they can, top to bottom. But of course, even when you see the Federal Reserve, and obviously this is a much lower number as a percentage of the GDP, it doesn't matter to me because the numbers are so excessive. This is the Fed balance sheet broken down on several levels. If you want to see all the details of that, I'm including that here. You can pause the video or check the link in the description. And then last but not least, my favorite chart of all, saved it to the end. If you stayed here till the end, you get my favorite chart, the S&P 500 and assets of major central banks. If you do not see the parallel in between these two, you need to go right away to the optometrist and get your eyes checked. Okay, don't stop the video right now. Go to the optometrist, get your eyes checked, get your LASIK eye surgery, get glasses, get contact lenses, do whatever the hell you have to do because you're blind. You got something wrong with your vision. Look at this right here. It is very clear to me exactly what's going on. Central banks print money, stocks rise. Central banks contract the monetary supply and the stocks will fall. This happens over and over again. Now we could have a real deflation that occurs because all people are basically selling off their assets, and then the central banks really respond to that and they will create major inflation as a result. That can absolutely happen. I just want to show you the correlation. I have made this clear long time ago about what happens, and we could see that the central banks increase their balance sheet, and I say, look, the Federal Reserve increasing their balance sheet, BOJ, the ECB, they're all doing it at least collectively as a whole. And of course, what do we have? We have increasing stock prices. It's pretty predictable. Of course, a day-to-day activity is really hard to determine, but when you see it looking at this chart, it is very telling. That's it. Video's over. Please give me a thumbs up. Where else do you get this kind of hard-hitting data that you can listen to the data and no garbage? Then all you got to do to support this channel is hit one button, hit the like button, and I thank you very much. If you want the financial education you were not taught in school, these two books have everything you need from top to bottom, A to Z. All the details are located at the link in the description. Check it out. If you want the audiobook, that's available at themoneygps.com. If you want to watch the first part of this video, I break down everything that happened. I look at the interest rate factor. I look at the historical context and everything you need to know. Click on it and I will see you there.